Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and a warm welcome to Money Talk from me, Peter Lewis. This podcast is currently ranked number 7 on the most listened to finance and investment podcasts in Hong Kong on Apple Podcasts. So if you're listening on iTunes, thank you very much for tuning in. You can also catch us on Google Podcasts and Spotify. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. Here are the business and finance headlines for Thursday, the 8th of June. The Canadian Central Bank has resumed interest rate increases after pausing in January. The Bank of Canada unexpectedly raised the target for its overnight rate by 25 basis points to 4.75% after pausing the tightening campaign in the previous 2 meetings. Markets were anticipating interest rates would be left on hold, and borrowing costs in Canada are now at the highest level in 22 years. The OECD has forecast that global economic growth will slow from 3.3% last year to 2.7% this year, before picking up to 2.9% in 2024. Growth this year is up slightly from the OECD's previous projection of 2.6%. However, when not including the pandemic-hit year of 2020, this would still be the lowest yearly rate since the 2008 to 2009 financial crisis. Chinese exports slumped more than expected in May. Shipments from China shrank 7.5% from a year earlier to a 3-month low of $283.5 billion, reversing from 8.5% growth in April. It marks the first decline in exports since February and the steepest decline in 4 months. The Australian economy grew at its slowest pace since the third quarter of 2021 in the first 3 months of this year, held back by high inflation and a consumer spending crunch. GDP expanded 0.2% Q-on-Q in the first quarter of this year, below market forecasts of a 0.3% increase, and after an upwardly revised 0.6% increase in Q4. On today's programme, I'm joined by Andrew Freris, the CEO of Ecognosis Advisory, and Andrew Sullivan, founder of Asian Market Sense. To talk about the oil markets, we have Vandana Hari, founder of Vanda Insights. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, the rally in US stocks paused Wednesday, with the broad market index fluctuating near its highest closing levels since August 2022. The S&P 500 ticked down 0.4% to close at 4,268. The Dow bucked the downward trend, adding 92 points or 0.3%, closing at 33,665. The Nasdaq Composite declined 1.3%, that's its worst day since mid-April. The CBOE Volatility Index, or the VIX, briefly touched 13.77 on Wednesday. That's the lowest since February the 14th, 2020. US Treasuries retreated after an unexpected rate increase by the Bank of Canada stoked expectations that the Federal Reserve may not be done raising rates either. The chance of a 25 basis point rate hike from the Fed this month rose to 29% from about 22% yesterday, according to CME Group's FedWatch tool, and the odds of another rate hike in July rose to 66%. The 10-year Treasury bond yield jumped 12 basis points higher to 3.80%. Hong Kong's Hang Seng Index jumped 153 points to 19,252 as more investment banks added to predictions that Beijing will deliver policy supports to help the faltering economy. Media reports of a planned trip by Secretary of State Antony Blinken to China this month also helped support the market. The tech index surged 2.3%. This morning, Hang Seng futures are pointing to a decline of 60 points or 0.3% at the open. The Shanghai Composite was 0.1% firmer yesterday at 3,198. The Chinese yuan hit a fresh 2023 low against the dollar, sliding to 7.147 renminbi in offshore markets. That's its worst level versus the dollar since November last year. Mainland media reported that some of China's biggest lenders cut rates on US dollar deposits in a move to slow the decline in the yuan. It was later reported that regulators asked major state-owned banks to lower deposit rates by as much as 100 basis points to 4.3%. You can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money
Time to welcome our Thursday morning guests. As always on a Thursday morning, we have with us Andrew Freris, who is the CEO of Ecognosis Advisory. Morning to you, Andrew.
Good morning.
And also joining us is Andrew Sullivan, who is founder of Asian Market Sense. Very good morning to you, Andrew.
Good morning.
Trade data out of China yesterday showed exports slumped more than expected in May in a further blow to the country's hopes for a strong economic rebound from the COVID-19 pandemic. Exports from China shrank 7.5% from a year earlier to a three-month low of $283.5 billion in May. That's reversed from 8.5% growth in April. Economists had been expecting a 0.4% drop. Andrew Freris, we've seen 3 months of pretty strong export growth, haven't we? Which surprised people, rather, given the state of the global economy. But that now seems to have reversed. What can we sort of read into this?
Well, there are actually, I will not agree that you have been seeing even relatively strong growth. In the last 8 months, 6 of the numbers year on year were negative and 2 were positive. So growth has been sort of flickering. Ditto with inputs. Actually, I am much more interested when we come to look at the Chinese economy at this particular hiatus of what's happening to inputs rather than exports, because inputs reflect, of course, what's happening to the industrial output and indirectly to exports, because China has got a huge inputs to exports ratio. In other words, in order for them to export, they need to input, and they're not importing. Again, in the last 8 months, 7 months were negative and only 1 month were positive in terms of year-on-year growth. Having said that, and I'll finish very quickly, net exports, I'll repeat that is, in other words, exports minus inputs, growth in China reflects, causes a tiny percentage growth in GDP. So China has never been, in the last 20 years, an export-driven economy, whatever you might be reading. It has been primarily and hugely a domestic economy driven. That's why I'm not really incredibly upset of what I see in terms of its potential impact on its GDP growth.
And just to add that imports figure to the data, imports did perform a bit better than expected. They declined 4.5% year on year, and that left the country's monthly trade surplus at $65.8 billion, well below forecasts of $92 billion and compared to $90 billion in April. Andrew, what do you make of this?
Well, I think, as Andrew was saying, I mean, it's the domestic consumption is under threat in China, and a lot of that stems from the problems with the housing sector. And if the government wants to try and stimulate the economy, I think they've got a further problem in the local authority debt. In the past they've used infrastructure and local authority vehicles to stimulate the economy, but that can only go so far, and that's going to be a big overhang for the next few months, especially when you've got high unemployment, especially in the youth sector, and another crop of graduates coming out to the market shortly.
If there's not going to be exports, if exports has now sort of turned, we have sluggish consumption as well on the mainland, what is it that's going to hold up the Chinese economy?
That's one of the reasons you're seeing the current sell-off in China is the fact that we're all trying to guess at what that's going to be, and until the government comes out with some sort of stimulus package or some blueprint plan for which way they're going to go, it's going to be very difficult.
And what type of stimulus could the government come out with? There's been talk about RRR cuts, hasn't there? But is that going to be effective? Do we need that or some other type of stimulus?
I doubt whether RRR cuts are going to be that effective. I mean, the reality is, and as we've seen in Japan in the past, is you can lower interest rates, but I mean, if companies don't think that they can use that money profitably, they won't borrow, regardless of how cheap the money is. And I think that's especially true in China, that companies and people generally are very cautious. If they're confident, they're happy to go and spend. If they're not confident, then they're not happy to take on more debt or to speculate.
Andrew Freris, what will hold up the economy?
Well, I'll chip in, actually. We have been seeing repeated news now that they are cutting interest rates on deposits. Hello?
By 100 basis points, reportedly.
Yeah, I have no idea how this is going to somehow stimulate consumers and domestic producers to go and produce more. If you can do that on borrowing, but doing it effectively all right, on what people earn on their deposits, I have no idea how this increases potential for consumption. Really, I don't understand.
Well,
the important part...
And also, that's on, just to clarify, that's on dollar deposits, and I presume most people in China don't have US dollars.
Yeah, well, to put it mildly,
they can hold US dollars so many per year, and I think historically they have done, but they've kept those in US dollar terms rather than sending them overseas. So there probably are some sizable deposits there on household savings because it's a nest egg that's giving them some security.
Andrew Freris?
People Bank of China is traditionally very reluctant to increase or decrease interest rates. They don't like doing a Fed. They prefer, in fact, to vary the reserve requirements. And it has been cut starting from now, 12 months backwards. I can think perhaps the number is not quite right, but at least 3 times in which reserve requirements were cut. And that increases the liquidity of the banks. But as Andrew is also pointing out, making the credit cheaper does not necessarily encourage people to borrow, particularly as in the case of purely domestic private consumption. Home prices have been falling, say that slowly, have been falling negative year-on-year growth for the last 13 months. Oh, wow. If that's not, this is the index of new housing in 70 major Chinese cities. I want to emphasize that this is perhaps a rather narrower index, but it is very indicative on what's happening in the new market.
So if you're not impressed by China asking the big banks to cut deposit rates to boost the economy, what about the other measures that they're talking about, which are basically to try and support the property market, to come up with new regulations on lowering down payments, reducing agent commissions on transactions, that type of thing, which is really on top of the 16-point plan we saw back in November that didn't work?
Well, that makes a lot more sense, given that this is a major weakness in the economy, and then it drives at least an aspect of not just what's happening to your wealth, but also what is happening to expectations.
And I think the other thing to take in account there is the fact that realistically, at the moment, the developers are concentrating on completing buildings. We're not seeing new land sales. We're not seeing new developments taking place. There is an overhang, yes. They've got to develop these buildings and complete them because these are ones that people have already started paying for. But, because of the log jam at the local authority level and the fact that the developers got starved from credit, they haven't been able to buy new land and keep what was effectively the Ponzi scheme going on property.
How long can this keep going? I mean, there's concern, isn't there, about these local government finance vehicles and the amount of debt that sits in them. I mean, S&P Global Ratings estimates it at about $6.5 trillion. What sort of overhang is that going to be?
Well, I think it's going to be a huge overhang, and I mean, it's something that, effectively, in order to stimulate the economy, the government is going to have to repackage that debt some way. They're not going to write it off. They're going to probably extend the loan terms. But a lot of that debt is effectively held by the state-owned banks because they've always, viewed it as a safe borrowing channel.
Andrew Freris, what do you think about that? Is local government debt, is this a risk now that we should be worrying about and focusing more on?
Chinese domestic debt has been an issue of sex and violence for several years now. And the whole point is can China domestically default? Okay, so I'm going to take the very broad view, and that is China has got a net external lending position. It is a huge global lender. Domestically speaking, the fact that it has a fiscal deficit as a percentage of GDP that can easily double and still be well below the sort of 10% to GDP, which is globally somehow is expected to be a good or a bad sign. I never felt particularly upset that if some municipalities went bankrupt, then that the state could not step in reluctantly.
So net lenders, basically, they don't default. That's in effect what you're saying.
Precisely.
But presumably it has an impact, doesn't it, on the local government's ability to stimulate the economy?
The other thing is, I mean, they've done very well in past times in stimulating the economies, but there's only so many roads, so many bridges, so many airports that local economies can actually build. And the final result is really, do those add actually any value to the local domestic income? And in a lot of these projects, they're really not returning the money that's been invested in them.
Now, what about the global outlook? We've had the OECD. They've raised their annual growth outlook. This year, they're saying growth is going to slow to 2.7% this year from 3.3% last year, but then pick up again 2.9%. We've also had an outlook from the World Bank as well. They raised their 2023 growth outlook, but did go and cut their 2024 forecast. So, Andrew Freris, first of all, let me ask you to kick off with that. In terms of global sort of growth, how are you seeing it?
Well, I was going to tell you, unfortunately, I have a very relaxed view on World Bank and IMF forecasts of global growth, not because I don't believe them or I think they are wrong or they don't get it right. Effectively, they're irrelevant. I have no idea. Okay, so global growth will increase. What I really care is what is the component of that growth. And the component of that growth is primarily China. It tends to add a substantial percentage, okay, to the growth. And then, of course, the G8 economies. So, global growth is increasing from 2% to 2.x%. And my reaction is, and so what? What does that tell me? Most definitely, it doesn't tell me anything about what to buy or sell. I will add something very quickly. I was reading the surprise and the chagrin of German exporters to China who are equally saying nothing is happening. I mean, this is one of our key markets, and we really are neither exporting a lot or exporting at all. And that's why I go back, in fact, to the inputs from China as a major, if you want to look in terms of global trends, that will be let's say, worrying us, as opposed to whether the GDP globally has gone up by another X 10 basis points or whatever it is.
I mean, the global economy is generally slowing. And I mean, I think as Andrew said there, and it's been a big impact for Germany especially. But that's really a reflection, I guess, also of the fact of the impact of the zero COVID, the US sanctions, people friendshoring or moving their supply chains slowly out of China, and that a lot of people will be looking at China and their production in China for domestic consumption within China rather than being an export hub for the world that we've seen over the last 10, 15 years.
Let me ask you both, do you see the central banks, are they winning their fight against inflation? I mean, we had data in this region, we had data this week, inflation data from Thailand and the Philippines, both of which was much lower than expected. Are they winning this battle, Andrew Freris?
Well, Aussie, for example, looks as if they are getting there, except Canada, of course, that increased interest rates. The answer is yes, it is a hiatus. And at least in terms of the year-on-year numbers, both in the case of the European Union and in the States, it's coming down. Yeah, but unfortunately, not anywhere near the 2%, which is the target. So I would not be surprised at all that the end of the increases in interest rates will come by the central banks actually increasing their expected inflation in the next 2 to 3 years. In other words, 2% might be unrealistic. And it doesn't help that OPEC, of course, is planning to increase oil prices by reducing its output.
I mean, I think one of the key things here is the fact that 2% long-term average that the Fed is targeting reflects the fact that interest rates, though, have been manipulated by the Fed since the great financial crisis. So they've been unrealistically low because was the Fed's policy. So to say that is the long-term average, I think, is, as Andrew is saying, it's actually wrong. It's probably going to have to be higher than that. And we're just going. But even at 2, 3, 4%. I mean, long-term average that most of us grew up with, interest rates were above 5% for most of the time.
Do you think China, which has sort of got this, well, not deflation, I suppose, but disinflationary trend, is that going to hold back inflation elsewhere in the world? In other words, is China sort of stalling growth? Is that going to keep this disinflationary trend intact that we're seeing in other parts of the world, Andrew?
Well, that depends on two things. Depends on how strong and good China exports are, because that will be an import price component into the inflation of other countries. And these exports are not holding up. And the second point is that also the producer price inflation in China is also very low and coming down, and that will be an extra, let's say, comforting reason. But as long as China is not exporting, and it's not exporting because it doesn't want to, it is because other countries are not importing. I'm sorry, this is Nobel Prize winning stuff. Then I'm not quite sure how the Chinese inflation number helps global inflation numbers. And we must never, ever, ever forget, we always concentrate on United States, European Union, and we'll forget the two other major economies, and that's China and Japan. And Japan, of course, inflation, at least as we come back on a year-to-year basis towards the end of the year, inflation is going to go straight back to 2%. In other words, Japanese inflation is low. And finally, oh God, I really sound like an economist, whether this is going to have any impact at all will also depend, of course, on the exchange rates. If the yen continues to be relatively weak, all right, therefore making imports relatively cheaper, irrespective of whether people are not still importing from China. Sorry, their growth of imports is not there.
Yeah, I think I agree with Andrew on that. I mean, if China's not exporting, and of course, part of the reason China's not exporting is because, you know, the sanctions against it. It's having trouble getting hold of advanced chips, and it was looking to move up the technology ladder to try and export more added value. But until the situation between America and China improves, and they come to some concessions between each other, I don't think that's going to change.
Where does the US fit into this? We've had the jobs data a week or so ago, which was surprisingly strong, but then we had the services PMI, which was surprisingly weak. What's the situation in the US, Andrew?
Looking at the real interest rates in United States, it doesn't look good in terms of the probability. Actually, I wouldn't say probability, the near certainty that the Fed is going to increase again, because inflation has dropped below 6%, is about 5%. Interest rates are 5%, and therefore real interest rates are zero. And they have been negative for yonks. So in other words, for real interest rates to become positive, not that it means anything to consumers and producers, but it is a useful indicator of the underlying trend, then we're not having a tighter monetary policy. And this takes time to work through. So as far as United States is concerned, we're doing fine, but assuming, and I always don't fight the Fed, assuming that the Fed still keeps with 2%, then they are going to increase interest rates again.
Yeah, I think that's very clear. I mean, they've got very little option at the moment. And I mean, you know, Powell has said for ages that he's going to, you know, keep rates higher for longer. It was just that the market tended to take a view that against that. And as Andrew was saying, yeah, the phrase has always been "Don't fight the Fed." And yet earlier this year we saw the markets, you know, assuming that the Fed was going to start cutting rates, you know, later this year, and that just didn't seem to make sense.
So it's going to be a skip, is it? That seems to be the latest buzzword, doesn't it? A skip this month rather than a pause and then more rises next month.
Well, I mean, they're still going to be data dependent, and they'll look at the data that comes out ahead of that meeting. My own feeling is I think they'll probably continue to raise rates because, you know, they want to try and squeeze the inflation out. I think Powell has already said that he's quite happy he doesn't want a recession, but he's quite happy to accept it that they might have a mild recession if it means that he can squeeze his inflation again, and that's going to be his main goal.
Andrew Freris, I mean, you've been adamant for a while that there's going to be more rate hikes, including one this month. Do you still sort of hold that view?
Oh, very much so, because, as I said, inflation looks okay. In other words, it is going where it is supposed to go, but it is a very, very long way away. And unless I hear the Fed saying, well, forget about 2, it's going to be 4%, then I can't possibly think that there is something there that will make the Fed to say, we are holding. Or perhaps we will continue in a few months' time to begin cutting interest rates. No, they won't.
Okay, I want to turn our attention to this crackdown on cryptocurrencies. On Monday, the SEC filed 13 civil charges accusing Binance of unlawfully soliciting investors and customers, lying about the degree of trading on the platform, misrepresenting its oversight and risk precautions, and improperly using customer funds. Then on Tuesday, the SEC charged Coinbase, the biggest crypto trading platform in the country, with operating illegally as it widened its crackdown on the industry. And together, Coinbase and Binance account for half of global trading in digital assets. So what sort of impact is this going to have?
Well, I think one of the key things, it will make investors more cautious about really where they hold their money. And certainly with crypto, I think you'll see an increase reliance on what they call cold wallets rather than leaving money on the exchanges. And I think that makes an awful lot of sense. I think as far as the cryptocurrencies are concerned, I mean, ever since FTX, we saw the Bitcoin sell off on the back of that first debacle, but it's recovered and it seems to be relatively stable around that sort of 26,000 mark. And people are happy with it. So, it's here to stay. I think the crackdown is, it's an interesting one because obviously, saying these exchanges are illegal and yet having allowed them to operate for so long makes a bit of a fallacy of the charges that it's now bringing. But it's, it's still evolving. And I think one lesson to take for it is the fact that we hope that when it comes to AI, governments are a lot more, have a better framework in place much quicker than what we're seeing the SEC do in retrospect now on crypto.
Andrew, I was just about jokingly say, please don't start me on Bitcoins, because I have been quite a virulent critic of this aberration. Now, I have to be fair to them here in the sense that it isn't because they are Bitcoins that they are being naughty, because we had plenty of banks that are not Bitcoiny at all, such as Credit Suisse and the Silicon Valley Bank, that also screw up in terms of their regulatory approach. However, there are too many Bitcoin banks and operations, being caught continuously on the wrong side of the law. And I'm rather pleased with that, because I can't think there cannot ever be enough restrictions on warning people as to what Bitcoin is, and the fact that they are trading on an asset, in inverted commas, that has no assets whatsoever backing it. So I have no idea how the regulators will ever get around the fact that they are looking at an institution which is selling something that has absolutely no intrinsic value behind it. And if it ends up being backed by US dollars, then it will be just another boring representative asset. But trading Bitcoin, I'm using it generically now as Bitcoin, you're trading nothing. So I have no idea how the regulators will control nothing.
Yeah, I think it's a phase. I mean, it's been around for a while now. People rely on it in a digital form. And it's the fact that actually, the youth of today, they play online games, they buy online assets to play those games. They seem to be happy with it. So I think it's here to stay.
What does it mean for Hong Kong? Hong Kong wants to be a trading hub for digital assets. It wants to open it up to retail investors to allow them to buy digital assets as well, under certain restrictions, of course. But then you have the chairman of the SEC, Gary Gensler, saying that the whole industry is built on non-compliance. So is it possible for Hong Kong to be a centre for digital assets, Andrew?
Actually, Peter, I cannot see how this could be the case, since still trading Bitcoins in China is illegal. I really don't. I fail to see whether this is driving. And given that I don't like Bitcoins, the answer is I don't like to see things that are encouraging people to trade on something which has no intrinsic value. It's not a matter that I know better than they do, but let fools step in where angels fear to tread, and that's their own business. But officially to say, yes, we sanction it, we think it is a very good idea that you trade. Why they encourage people to smoke, for God's sakes? People know that smoking causes cancer. All right, fair enough. So, why we should go around trying to discourage them? I have no idea why the same thing is not extended, to trade in an asset that has no intrinsic value. But that enters now into moral hazard, it enters into politics, it enters quite a lot. And as I say, I've said enough.
I think Andrew's right. I mean, I think that the reality is, though, that this is an area of trading where there is no common international standards. And, what the SEC is trying to do at the moment in the US appears to be to try and, control this space. But realistically, there should be, some international standards, some baseline that everybody should work to.
Okay, finally, let me just get your thoughts on the markets. The Hang Seng and Chinese stocks in general, they seem to be getting sort of a little bit of a bounce on these reports of, rumours of policy support. Also, it was supported yesterday by reports of this planned trip by Secretary of State Antony Blinken to China this month. It was obviously a very bad month in May for the markets, but what do you think the outlook is?
Well, I think I still think volumes are very light, which tells you that there's no new money coming into these markets. A lot of it is trading around short positions. People have, China has tried over the last 6 months to talk its own book up and to inspire confidence, and it seems to be failing in that regard. And I think a lot of investors are waiting to see solid policy moves before they are prepared to take a stand. And in the meantime, we're seeing money rotate out of China, certainly into Japan, where there seems to be policy change in the offering there, and into Korea and Taiwan, which are beneficiaries of the moves in AI.
Andrew Freris, final word to you. What are your thoughts on China equities anyway, relative to maybe other markets in the region?
In my favorite Bloomberg screen, where everything is green, where we're year on year in US dollar terms up, the reds are now popping up much more continuously. In other words, the markets are uncertain. All right. And now that means absolutely nothing except that an increase in Fed interest rates might trigger a repositioning, meaning, in other words, markets coming down. So I am not doing anything on the equity side, as an asset class for at least another 2 months.
Okay, well, thank you both very much. You heard there Andrew Freris, who is the CEO of Ecognosis Advisory, Andrew Sullivan, who is the founder of Asian Market Sense.
Peter Lewis's Money Talk.
I'm joined now by Vandana Hari, who is the founder of Vanda Insights. Very good morning to you, Vanda.
Good morning, Peter.
Let me get your thoughts then on this surprise Saudi production cut, which came last weekend at the OPEC Plus meeting. Seemed to have taken people off guard, didn't it?
Yes, Peter. I think the biggest surprise probably was that it was a bit of a damp squib, especially in light of the Saudi energy minister's repeated warning to short sellers just a few days before the meeting. The expectation in the market, at least as far as oil bulls were concerned, was that perhaps as a de facto OPEC leader, Saudi Arabia might be able to cobble together a wider contribution within OPEC Plus to a much bigger cut. And what turned out from the meeting was just this unilateral, voluntary Saudi cut of 1 million barrels per day, only for 1 month, just for July. So it was just nowhere near enough to provide a prop to crude prices. Some views in the market are perhaps it may have put a floor under crude. That so far seems to be borne out. We have seen sort of Brent around the mid-70s, but certainly not anywhere looking like it's going to shoot up beyond 80.
So why did Saudi Arabia do this then? What does it hope to achieve from this? Because as you say, it's nowhere near enough. It may only just be for 1 month. What are they trying to signal here?
Yeah, so there's the official narrative, which is that he used a lot of colorful phrases, the Saudi energy minister saying it was the icing on the cake, a lollipop, and that they are just a precautionary cut even, if you will, so on. But what the market perceives it as I said, is just not enough. And also what it perceives it as is that there was probably no appetite in the wider group There's 19 members in all that are participating in this production management pact for the past several years, that nobody else just was in a mood to cut. So Saudi Arabia had to go it alone. That's the perception in the market.
So is Saudi Arabia losing its influence then in trying to keep all these oil exporting nations on the same page? Because we did get the impression, didn't it, that it was a rather divided OPEC?
Look, I think tensions, divisions, rifts in OPEC and OPEC Plus have been common. They will remain a part of the life of this alliance. I wouldn't go so far as to say that they are losing influence. At the end of the day, it's pure mathematics. Just Saudi Arabia and Russia, by virtue of being the largest producers by far, the second and third largest producers within that alliance are close to a third or less than half of what these two produce. They will have an influence, and precisely because of what Saudi Arabia did and has done before in saying that it's fine, we'll go it alone. So I think Saudi Arabia will remain the sort of de facto leader, as we like to call it. That's not changing, but yes, there are a lot of tensions, and I would say more tensions ahead for the group as they're doing some big house cleaning in the coming months and next year in terms of realigning quotas of the several members that have been falling way short of their production quotas.
Does leave Saudi Arabia rather exposed, though, doesn't it? Because I thought the whole point, really, of OPEC Plus, or one of the reasons for OPEC Plus, was so that Saudi Arabia didn't get put into the position where it had to cut production unilaterally, as it did famously in the 80s, for example. And OPEC Plus was sort of designed to avoid that situation, but it does seem to have been left high and dry, doesn't it?
Yes, I wouldn't argue against that point, Peter. You're absolutely right about in terms of that is the concept of working in an alliance and trying to get cohesion, collaboration, and moving together forward. So I think what I would conclude from those two arguments is that basically I think Saudi Arabia will have to use this going it alone strategy very judiciously, which I would say so far it has been. I mean, it's like a trump card. You can't continue to play it again and again with the same effect. In fact, I think it's already proven this time around that it did, the trump card just didn't work. But I do believe that they know that, very, very smart people goes without saying, running the ministry and the strategy there. So I think they will use it sparingly. And they will try to move forward with a consensus and everybody pitching in with whatever they do, whether it's raising or reducing production.
So how significant is OPEC as a price setter these days? Is its influence waning, or is it still a very powerful cartel?
So when you say these days, then, in the short term, I would say it's a bit powerless because, let's face it, it's not so much a supply problem, it's a demand problem right now. And within that, it's not so much the physical, real demand problem. It's always difficult to measure exactly how many barrels the world is consuming every single day. But it is the perception of demand problem. So crude has been moving up and down, largely in line with the sentiment in the broader financial markets, and to some extent with what's happening with China, macroeconomic data in China, which has been quite disappointing as well. So it's a perception problem within OPEC Plus. But in terms of supply-demand balance, so OPEC is now having to be responsive, and it is being responsive not so much to the physical signals as to what, let's say, the speculators might be doing just from fear and panic sometimes, right? Funds move out of asset classes and they move out of crude as well. So, but longer term, it's OPEC Plus accounts for more than 40% of global supply. So I would say as long as it manages to stay together, they will continue to have an influence.
And presumably, if you want to try and predict oil prices these days, what you've got to watch is the data that's coming out of China on their economy. So things like the trade data that we saw yesterday, which showed this big slowdown in exports, also a slowdown in imports, although not as much as the exports slowdown. That's quite significant.
Absolutely. So just to put this in context, China, with its consumption of about 15 million barrels per day of oil, accounts for 15% of global demand. It is, yes, of course, India is a third largest consumer, but, far behind China. So basically, the world of oil looks very closely at what the tea leaves are saying about China. And exactly as you mentioned, the oil imports, crude imports, oil demand data has been a bit, hard to pin down in one way or another. But the macroeconomic data in China has not been very encouraging, especially the industrial sector is lagging, which in terms of rebound, which means, has implications on diesel consumption in China. Gasoline and jet fuel demand, not surprisingly, are doing quite well out the gate, as people are traveling much more. Services are doing well. But, if diesel demand doesn't pick up in China, then overall it's going to remain a drag on the consumption rebound of the country.
So if you want to put all of this together, where do you see Brent crude oil going over the coming months?
Yeah, so again, in the very short term, the complex is looking to the Fed meeting next week. Again, as I mentioned earlier, it's all very sentiment-driven, very driven by what the economic expectations are. And of course, those are principally centered on what happens in the US, what happens in Europe. And for the coming months, I would say, again, the market will keep a very close watch on how Chinese appetite is recovering, and it will keep a very close watch on what the sort of recession view is with regard to the US. Overall, I don't see, of course, OPEC will be there trying to impact from the sidelines, but probably ending up trying to put a floor under prices rather than boosting them. I'm thinking 70 to 80 range, more like mid-70s. I'm certainly not in the camp that says that prices are going to go above 80, above 90 or 100 in the second half of the year. I'm really not sure where that comes from.
But if OPEC is trying to put a floor under prices, the problem is there's Russia, which is selling oil more than $20 below the price on world markets. So it sort of blows the OPEC strategy apart, doesn't it?
Bingo. So not only that, but Russia has actually not been delivering on the 500,000 barrels per day, quote unquote, voluntary cut that they pledged way before the OPEC plus voluntary cuts came about declared at the beginning of April and which were implemented from May. Russia was saying they will cut output by 500,000 barrels per day from all accounts. Of course, they do not give out official figures anymore since last year, but by all accounts, based on ship tracking data, export data from that country, they have cut, but maybe like about half of what they had pledged. So not only is Russia eating into Middle Eastern peers' markets, 30% discount is huge on oil, but it is also not quite complying with its promise of 500,000 barrels per day cut. So that's a major problem. It could remain a major source of tension within OPEC Plus. I think to some extent, the Middle Eastern peers understand that the country is in a difficult situation. They might just let it slide. But for how long, before it sort of drives a wedge into OPEC Plus, I think that remains to be seen.
And of course, finally, the big beneficiary of that is India, which is importing now more oil from Russia than it does from Iraq, Saudi Arabia, the UAE and the US combined. That sort of also undermines OPEC as well, doesn't it? Because OPEC's share of imports to India is now at its lowest in about 22 years. But this is a big boon for the Indian economy.
Absolutely. And why wouldn't they? it's not Russian exports aren't banned. What the West, the EU and the G7 have done is they've said that you have to buy your product, the oil from Russia under a certain cap, which they've put for $60 per barrel for crude. If you want to use Western services, insurance and trade financing and shipping, but a whole industry has cropped up that is not aligned in any way to the EU and G7 services providers, whether it's finance or shipping and so on, which is very happy. Well, mostly the oil has been trading under the cap, but this industry that has cropped up, the dark fleet, you keep hearing about that, of ships which are, have nothing to do with the Western alliance, are very happy to transport oil if it is not been concluded under the price cap. So these massive trade flows shifts have happened. You're absolutely right. They are benefiting India in a big way, and likely to continue as long as I suppose the war continues and the sanctions remain in place.
Vandana, always a pleasure talking to you. Thank you very much indeed.
Thank you so much, Peter.
That's Vandana Hari, who is founder of Vanda Insights. Thank you for listening to Money Talk this morning. Do please take a look at my newsletter at peterlewismoneytalk.substack.com for more information on developments during the Asian trading day. I'll be back tomorrow with another episode of Money Talk, and I'll be joined by Francis Lund, the CEO of Geo Securities, and Kenny Wen, Head of Investment Strategy at KGI Asia. Have a great day.
Money Talk